In 2018, Elon Musk paid $0 in federal income taxes. That year, the average American worker paid $8,367. This is not a theory, not speculation, not some Reddit post. This is verified, documented fact, confirmed by the actual IRS tax returns of America's wealthiest people, obtained by ProPublica, one of the most respected investigative news organizations in the United States. And it wasn't just Musk. Jeff Bezos, $0. 2 separate years. Mark Zuckerberg, a fraction of a percent. Warren Buffett, a man who turned $10,000 into a $100 billion empire, paid a lower effective tax rate than his own secretary. He admitted that himself, on the record, to Congress. Tonight, we're going inside the machine, the legal IRS-approved Congress-written system that lets America's ultra-wealthy make their tax bills disappear, while you couldn't even write off your student loan interest. This is how the game is actually played.
June 8th, 2021, ProPublica published what the New York Times described as one of the most significant tax investigations in modern American history. They had obtained the actual IRS tax return data for the 25 wealthiest Americans in the country. Real numbers, real years, real names. And what they introduced was a concept they called the true tax rate. Here's the difference. The official U.S. federal income tax rate tops out at 37%. That's what the IRS publishes. That's what your tax bracket is based on. But your income, your salary, your wages, that gets taxed every single year. Billionaires don't live on salaries. They live on wealth. And wealth, the kind that grows inside stock portfolios and real estate empires, is treated completely differently under the U.S. tax code. So ProPublica asked a different question. Not what percentage of income did they pay, but what percentage of their wealth growth did they pay? The answers were staggering. Jeff Bezos, from 2006 to 2018, his net worth grew by roughly $127 billion. He paid $1.4 billion in taxes over that same period. That is a true tax rate of 1.1%. Warren Buffett, between 2014 and 2018 alone, his wealth grew by $24.3 billion. His total federal tax bill during that stretch, $23.7 million. That is a true tax rate of 0.1%. Not 10, not 1, 0.1. For every $1,000 Warren Buffett's fortune grew, he paid $1 in taxes. You, working a salary job in America, paid around 13 to 14% of your income. The question is obvious. How?
To understand everything else in this video, you need to understand 3 words: unrealized capital gains. Here's how it works. When Elon Musk's Tesla stock goes from $200 to $800 per share, his net worth just increased by billions of dollars. But he doesn't owe a single cent in taxes, not 1 penny. Because in the United States, under the Internal Revenue Code, you are only taxed on a gain when you sell an asset. Until that sale happens, the gain is unrealized, paper money, and paper money is not taxed. This is the entire foundation. Every strategy we're about to cover builds on this one legal reality. Your employer takes 22, 24, 32% out of your paycheck before you even touch it. Musk, Bezos, and Buffett can watch their fortunes grow by tens of billions in a single year and owe the IRS absolutely nothing. Unless they sell. And here's the secret. They never have to sell because they can borrow.
This is not a tabloid headline. This is a documented tax strategy, formally named and studied by law professors at USC and other American universities. It is the backbone of how generational wealth avoids taxation in this country. It works in exactly 3 steps. Step 1, buy. You acquire assets, stocks, private equity, real estate. These assets grow in value. You pay 0 tax because you haven't sold anything. Your wealth compounds untouched by the IRS. Step 2, borrow. Instead of selling those appreciated assets, which would trigger taxes, you walk into JP Chase, Goldman Sachs, or Bank of America, and you borrow against your portfolio, hundreds of millions of dollars, sometimes billions. The interest rate, historically between 1% and 3% for clients at this level. You now have cash in your pocket, cash you can spend on anything, a Gulfstream G700, a super yacht, a private island, a rocket company. And here is the critical part. A loan is not income. The IRS does not tax money you borrow. It is written explicitly into the U.S. tax code.
According to Bloomberg's reporting on SEC filings, between 2019 and 2021, Elon Musk held margin loans against his Tesla shares worth at least $57 billion. That's public record, SEC disclosure, not a leak. Bezos used similar mechanisms. Documented, filed, legal. Step 3, die. This is the part that should make every American furious.
If you hold those appreciated assets until death, if you never sell, your heirs inherit them at the current market price. The entire history of gains is legally erased. Your heirs' cost basis resets to today's value. This is called the stepped-up basis. It lives in U.S. Tax Code Section 1014. Concrete example. Your grandfather bought Amazon stock in 1997 at $18 a share. He held it, never sold. It grew to $185. He passes away, you inherit it. Your cost basis is now $185 per share. The $167 per share gain? Gone. Never taxed. Not now, not ever. The Congressional Budget Office estimated this single loophole cost the U.S. Treasury approximately $41 billion per year. Every year, year after year. Schools, veterans programs, infrastructure. $41 billion redirected away from the public because Congress has never found the political will to close this loophole.
Now let's talk about the people who manage the money of the ultra-wealthy. Hedge fund managers, private equity partners, the titans of firms operating out of Park Avenue in Greenwich, Connecticut. If you earn a salary in America, your income is taxed at ordinary rates, up to 37% federally. But hedge fund managers collect what's called carried interest. This is their cut of the fund's profits, typically 20% of all investment gains they generate, regardless of whether they invested a single dollar of their own money. And here is the legal sleight of hand. The U.S. tax code treats carried interest as a long-term capital gain, taxed at a maximum of just 20%, not 37%, 20%. These managers did not invest their own money. They managed other people's money. But they received the tax treatment reserved for patient investors who held assets for years. Not workers, not professionals, investors. The Brookings Institution in Washington, D.C. estimated this one loophole saves the hedge fund and private equity industry approximately $14 billion annually. And politicians know this. Multiple bipartisan coalitions have tried to close it. In 2010, in 2012, in 2017 during the Tax Cuts and Jobs Act negotiations, in 2022 during the Inflation Reduction Act, which, after intense lobbying, extended the required holding period from 1 year to 3, but left the core loophole completely intact. According to Open Secrets, the nonpartisan Washington, D.C. organization that tracks campaign finance, the private equity industry alone contributed over $600 million to political campaigns in the 2022 election cycle. Draw your own conclusions.
Peter Thiel, co-founder of PayPal, first outside investor in Facebook, one of the architects of Silicon Valley as we know it today. In 1999, he opened a Roth IRA. The Roth IRA was created by Congress to help ordinary Americans, teachers, nurses, factory workers, save for retirement with money that grows tax-free. The contribution limit in 1999 was $2,000. Thiel put in $1,700. But here's what he did with those $1,700. He used them to purchase founder-level shares in PayPal, a startup at the time, at a price of roughly 0.3 of a penny per share. Under IRS rules, private startup shares can be valued at essentially nothing if no market exists for them yet. PayPal went public in 2002. The shares exploded. Eventually, Facebook, Palantir, and other investments flowed through the same account. By 2019, according to ProPublica's verified reporting, Peter Thiel's Roth IRA contained approximately $5 billion. Under the legal structure of a Roth IRA, gains inside the account are never taxed upon withdrawal. That rule was designed so that an average American could protect maybe $100,000 in retirement savings. Peter Thiel will withdraw $5 billion and owe the IRS zero. After ProPublica's 2021 report, U.S. Senators Ron Wyden of Oregon and Sheldon Whitehouse of Rhode Island introduced legislation to cap tax-advantaged Roth IRA balances. As of today, that legislation has not passed.
It doesn't stop at individuals. The corporations themselves are running the same playbook at industrial scale. In 2017, Amazon reported $5.6 billion in U.S. profits. Federal income taxes paid? Zero. They actually received a $137 million federal rebate, meaning the government paid them. In 2018, the profit figure grew to $11.2 billion. Federal income taxes? Still zero. A combination of tax credits brought the final bill to nothing. How? The U.S. tax code contains hundreds of deductions, credits, and deferrals specifically accessible to large corporations. Amazon utilized accelerated depreciation on its warehouse assets, writing off the value of buildings and equipment faster than they actually wore out. They claimed R&D tax credits on cloud computing and logistics technology. They deducted the value of stock compensation paid to executives. Every single one of these mechanisms is legal. Most of them were written into law with the direct assistance of corporate lobbyists. Amazon spent over $20 million on federal lobbying in 2022 alone, according to Open Secrets. And then there's Delaware. Over 60% of Fortune 500 companies, Apple, Google, Amazon, Tesla, are incorporated in the state of Delaware. Not because they operate there, because Delaware offers extreme corporate privacy, minimal taxation, and a specialized court system called the Court of Chancery that has spent over 200 years ruling almost exclusively in favor of corporations. Delaware has 989,000 residents. It has over 1.9 million registered corporate entities. There are more companies registered in Delaware than there are people living there. Here is one final maneuver that's become increasingly popular among America's new class of tech and crypto wealthy: Puerto Rico. Under U.S. law, specifically the Puerto Rico Incentives Code, known as Act 60, formerly Acts 20 and 22, any individual who relocates to Puerto Rico and establishes genuine residency there qualifies for a 0% capital gains tax rate on income sourced from Puerto Rico going forward. 0%. Not 20, not 15, 0. And because Puerto Rico is a U.S. territory, not a foreign country, moving there does not require renouncing American citizenship. You remain a U.S. citizen. You keep your passport. You simply no longer pay federal capital gains tax. This is codified under IRC Section 933 of the Internal Revenue Code, the IRS's own rulebook. Crypto investors, hedge fund managers, tech founders who timed their exits right, dozens of high net worth Americans have quietly moved to San Juan in the past decade specifically for this exemption. The IRS is fully aware. It is completely legal. It was designed by Congress. The downstream effect on actual Puerto Rican residents, spiking real estate prices, displacement, and housing affordability crises is a separate and serious conversation. But for the purposes of this video, the mechanism exists, it's legal, and people are using it. Here's what ties everything you just watched together. None of it is illegal. Not one strategy, not one loophole, not one line of tax code. All of it was written by Congress, signed by presidents, and enforced, or deliberately not enforced, by the IRS. The people at the top of the American economy pay a lower percentage of their growing wealth in taxes than the people at the bottom of it pay of their stagnant wages. And the system that produces this outcome was not the result of oversight. It was not an accident. It was the product of decades of lobbying, campaign contributions, and revolving door relationships between the financial industry and the lawmakers who write the tax code.